Crypto markets consolidate gains ahead of the FOMC meeting this week. A 25 basis point cut is widely expected, but the guidance around further cuts in 2026 and liquidity measures to support treasuries will determine the next move for risk assets. Crypto vol has been grinding lower as we traded range bound this week, but skew is still in put premium as hedging demand persists. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran David from Options Insight. I've got my man Dave from FOMC. How's it going, man?
I'm good. I'm excited.
What about?
FOMC, of course.
Oh, of course. Yeah, we get to hear Jerome speaking again.
Yeah.
Spooking the market like he loves to do.
Yeah, it feels an important meeting, I think. I mean, like they all feel important, I guess, don't they? But this one, I think, particularly feels important.
But it's interesting how, like, the market repriced expectations around this so quickly, right? It's like last time he spoke, he was like, it's not a foregone conclusion that we're going to cut rates. Market got spooked, took the probability to like 20%. And then Williams talks dovishly and it reprices back to 100.
Yeah,
right?
I mean, it was a weird one because he actually, I think, in the last meeting, that was end of October, I think, Jay Powell was actually he was kind of trying to explicitly say we're probably not going to cut rates in December. And then I think maybe like Williams has been very much on to like the funding stresses and the issues around that. And he's been quite a forward thinking kind of member, I guess, of the Fed on that. So yeah, he come out with dovish comments saying we probably need to cut rates.
But my theory is
I think the data as well still looks like the labour market still looks a little bit shaky.
Yeah, but my theory has always been like, anytime Powell's hawkish about this, if we zoom out and be like, okay, then they haven't got to their inflation target, right? And they're cutting rates. It's like he's just trying to restore some little bit of Fed credibility.
Yeah.
When ultimately we know they're just running it hot and they're doing what they're told by the government, essentially, right? And that's going to be more the case next year when Hassett probably comes in, right?
Yeah, I think as well, like they're so kind of moving from data point to data point, which I think is problematic, right? And then also particularly when those data points, by their nature, are backward looking. I mean, we saw that last year, like before they started the rate cutting cycle. I think it was in like the August time of last year, actually, when things were blowing up, and they kind of came up with something quite hawkish. That market started to reduce the chance of cuts, and then they started off with a 50 bip cut because things just changed quite quickly. So I think they seem to bounce from data point to data point. They're obviously balancing the fact that inflation remains sticky. It's not accelerating higher, but I think what we got core PCE the other week at 2.8, 2.9%. So, you know, it's not really gone anywhere, but it's not coming lower. Meanwhile, they're looking at the employment situation, and there's still a lot of signs of softening there. So I think their balance of risks remain to, we're worried about the downside to the labour market, but you know, at the same time, inflation's well above target.
But I'd say US rates haven't really been that volatile, right? You look at things like the MOVE index and rate volatility, it is pretty damn low, right?
Yeah.
But the action seems to be in Japan. And
Yes.
now Germany has started to see a pop in yield as well. You put out a good tweet about Japan.
Yeah.
You want to elaborate a little bit on that?
Yeah, I think that's probably the most interesting market to be looking at right now, given that it's been pretty quiet, right? As we sort of chop into the Fed, but look, Japan is in like an impossible situation, I think, in that they're hiking rates because they have the proper stagflationary scenario,
And that means no growth or negative growth and high inflation.
high inflation. Yeah.
Yeah.
Q3 growth annualized was negative 2.3%. All right, we got that data yesterday.
That's pretty
the
bad.
Revisions.
Yeah.
Inflation's knocking around 3%. You know, compared to their target of 2%.
So real growth is horrendous.
Real growth's horrendous. You've got a Bank of Japan that needs to hike rates to stave off inflation. Meanwhile, you got the new PM that's come in, and because of the lack of growth, is enacting a fiscal package worth 135 billion. So you got this kind of conflict.
How does that work? Hiking rates in one
and they do it to address the problems that inflation's causing by doing the thing that caused the inflation in the first place. But obviously, this is a country with 230% debt GDP, and that they are just in, and this is the path that the US and everyone else is heading towards, and all fiat economies ultimately head towards. They're trying to, they're trying to maintain bond market stability with currency stability, and it's kind of you just got to pick one or the other. So they're hiking rates, the bond market's selling off. JGB yields are now like 10-year yields are around like 2%. They've not been there since I think 2007. So like these are big moves.
Yeah.
But the fascinating thing is, despite the more hawkish central bank, despite the divergent path with the Fed, who have been cutting rates and they've been hiking rates, the yen continues to trade under pressure. So dollar yen's actually not gone anywhere all year, but the dollar's been very weak, don't forget, in 2025. So the dollar and yen are like the two worst performing sort of major currencies out there.
Yeah.
But for Japan, that's worrying when it comes amidst, they've been the only ones that have been hiking rates.
Yeah, so they're diverging in terms of what they're doing with rates compared to the rest of the world.
Yeah.
Yet their currency can't really strengthen.
No.
Right?
But because they're hiking rates, what I call the wrong reasons, i.e. they've got stagflation. And then equally, the situation with the bond markets know is unsustainable. Like they can't allow the bond market just to collapse and yields like rip higher. So the Bank of Japan already,
and that's because they've got too much debt.
Yeah, exactly. Yeah,
right.
And the Bank of Japan have already been coming in to smooth that bond market volatility, i.e. they're buying up bonds. Now there's speculation that they might have to like explicitly go back into yield curve control mode.
But they can only buy those bonds by printing more money.
Exactly.
And that devalues their currency more.
So they've got this kind of conflicting policy between hiking rates at the front end, if you like, being forced to purchase bonds at the back end.
Yeah.
And then also just complicating it all even more is you've got the government doing fiscal stimulus, which just and basically it resembles very much an emerging market situation, right?
So it might be a case that like the yen could, at some point, it could just break out. Like dollar yen could break out. It's been in like a 2-year range of like 140 to 160. Yeah. If it takes out 160, do we see like 200 again or something?
Yeah. So
again. We've never seen 200, have we?
I think we did years ago. Yeah.
Really?
Yeah.
Okay.
Possibly. Maybe wrong. The interesting thing is that is going against like what consensus would be in the market. Like the market's been looking for dollar yen to tank, right?
Because they're hiking in Japan and they're cutting in the US.
Exactly. Yeah.
Yeah.
But
you know what they always say?
Part of the hikes are in response to the currency weakness, because the currency weakness then feeds through into inflation. So then they need to hike rates to kind of maintain currency stability. But then the bond market starts to fall apart. So then they need to intervene to protect the bond market. So we're in this unsustainable situation. Ultimately, the currency will be the escape valve. And so contrary to the view that dollar yen will come lower, I actually think the yen could really and come under speculative attack quite quickly. And dollar yen, we discussed earlier, I think dollar yen can hit 200 in the next year. So
if dollar yen did something like that, what does that mean for crypto? Does it have a direct read through to crypto?
Yeah, I mean, like, this is complicated, isn't it? Because on the one hand, dollar strength generally, and if that sparks broader dollar strength, is sort of negative, right?
But let's say it's a Japan-specific move, though. But let's say it's not broad dollar strength.
But my kind of view on it is, firstly, you've got another currency that's kind of in crisis, right? Which kind of reinforces the case for Bitcoin and gold and any kind of hard asset, right?
Do Japanese people switch out of yen into Bitcoin?
Yeah, like would make sense, right?
Yeah.
The other thing is, comparing Japan to like an emerging market scenario, with this uncontrollable debt and this conflict between central bank hiking rates to maintain currency stability, but then it comes under more pressure because it's unsustainable. Japan's the fourth largest economy in the world. You can't have that scenario. So they'll have to work with the US and the Fed, who are going to have to supply the dollar liquidity. So they're going to have to, I think, supply loads of dollars into the market to help keep a lid on dollar yen and try and help them out on the currency, because they can't go this alone.
And also, wouldn't China be really pissed off if the yen got massively devalued? Because it'd make Japan way more competitive than China, essentially, right?
I mean, there is an argument at the moment, which kind of complicates things a bit further, that China are actually trying to destroy their bond market in Japan, because Japan, the PM sort of made comments around Taiwan and how they defend Taiwan, which is generally just like, don't go there. If you remember, I think it was Pelosi went to Taiwan back in 22, I think, and treasuries were getting annihilated, and sort of Yellen had to come in and kind of just calm everything down and make the apologies. So there's a chance of that, but yeah, that's probably gonna annoy, that weakness would annoy, in theory, China, who are relying on exports as well, although they're printing huge trade surpluses right now, so I'm not sure how much of a concern that would be. But I think the big worry for the US is, and maybe we are starting to see it sort of percolate and feed through into the Treasury market. Yields are climbing, even though US Treasury volatility has been really subdued. Mm-hmm. The worry is that it starts to have a bigger impact. Although, again, I do kind of feel at the moment the fact that we're talking about, was it Hassett for the Fed governor, who's going to obviously be
Fed chair, right?
Fed chair, who's obviously going to do Trump's bidding and be very dovish. Yeah. So I think there's other concerns as well. Like the US has got its own problems as well. But I think if that starts to feed through into the Treasury market, then the Fed are going to have to work with the BOJ and that to, all right, how do we, what do you do to maintain or kind of keep a lid on all of this? And it all feeds back to the answer will be financial repression and liquidity. Yields kept artificially low, real yields kept probably negative, and that's the way that they're going to be able to sustain this unsustainable situation with debt and the dynamics around that. I mean, if their hope is that inflation kind of towers off, right? But again, all of this goes back to, they're going to need to financially repress the markets. They're going to have to control the yield curves as part of that, which is going to debase the currency, which should see the likes of Bitcoin, gold, and all hard assets kind of go through the roof. So again, it just feeds into my longer term bull thesis for Bitcoin. The question is, as you go through those periods, and when these kind of regime sort of shifts and changes, it tends to come with a lot of volatility. So it just what is the path to that? And it could be ugly. But I do feel, as we've seen with the problems in the US, like funding markets, they all seem very aware of it and the need to get ahead of it, because we've kind of seen these things play out in the past. So I just think that might even feed like a more dovish Fed, to kind of try and keep the pressure off the dollar yen. It's definitely going to lead to more liquidity.
Get out of the Fed this week, because 25 bip cut is nailed on, right?
25 bip cut is nailed on.
So that's not necessarily a reason why crypto would rally, right? If they deliver a cut.
That's like whatever now.
Yeah. So what makes us rally? Because last week it felt like we could have a little move to the upside, but it failed again. Yeah. Right. ETH kind of kissed 3,200 ish, pulled back. Yeah. Bitcoin 93 and a half, pulled back. Yeah. Now it hasn't collapsed. It's kind of consolidated, but we want that push to 95, and we want that push to 33.50, which is a big level on ETH, right? What do we need to get out of the Fed this week to see those sort of moves?
What we need is something concrete around the monetary or liquidity operations they're going to do at the front end to basically alleviate this funding stress. So we've been talking about elevated funding rates in the front end, because essentially they're trying to fund this huge Treasury bill issuance, right? The RRP, which we've talked about countless times on here, is now at zero. So there's not enough liquidity in the US system, right, in the funding market. So we're seeing like people go to that Fed standing repo facility, i.e. they can't borrow in the market, so they're having to go to the Fed. We're seeing like front end money market rates essentially be elevated, which says there's like some stress. And it's not like we're not in crisis situation yet. We're not seeing that kind of repo type crisis, but there's signs of it percolating like beneath the surface. I think now again, Williams has already spoke to the need and talked about abundant level of reserves and all this sort of stuff, and we're now falling from those levels that they need to supply liquidity. I think if they come out on Wednesday and go, right, we are actually now going to enact some sort of liquidity program to deal with that.
That will smell a bit like QE.
Yeah, well, I think it was a kind of a Fed expert type of guy at Bank of America, I think, came out this week and said that he's expecting them to announce a program of buying 45 billion of T-bills a month. 45 billion a month. Now, again, they might sort of sterilize that and say it's not really, we're sort of sterilizing those flows, but effectively, again, they're going to pump the money into the front end. If that gets announced, that I think will be a hugely dovish kind of twist to Wednesday. And again, it's when does it come in? Do they announce it from January onwards? And then we might chop a bit more because you still, until that liquidity comes in, you're still going to have the funding issues that could keep Bitcoin pressured. But obviously there could be a big reflexivity around that where people just anticipate it and then all the big institutions go, right, that's the trade now, let's just get long Bitcoin. So I think if they announce that, I think we potentially see Bitcoin rip. If they don't, I think we're just going to be in this messy, choppy range into year end, and it could get actually messy towards the downside as the year end funding not really squeezes, and you could have a bit of a nasty sell off into year end.
Cool. Well, on that point, this week's guest, I caught up with Checkmate, James Check. He's co-founder of CheckonChain. He's an on-chain specialist. He's been around for a while. Have a look what he had to say. It was a really good chat with him. All right, guys, I've got another amazing special guest today. It is James Check, co-founder of CheckonChain. Welcome to the show, mate.
G'day, mate. Thanks for having me on.
No, awesome to have you here. I've been looking forward to our conversation. I was actually a reader of your stuff back in the day when you used to write for Glassnode in like 2021. Because, I wanted to know what was going on chain, and you had a great way of kind of describing what was happening in a pretty intuitive, understandable way, breaking things down like I like to do in options, basically. So I thought it was really good. So yeah, let's jump in. So before we get started, why don't you quickly give us, I think your background is quite interesting. So tell us a little bit about your background, like what you did before crypto, and then what brought you into the Bitcoin and crypto world.
For sure. Yeah. So I bought the 2017 top. That was the first thing I'd ever bought. I didn't own a stock. I didn't own property. I owned a car, and I bought Bitcoin at the absolute peak. And as we all did in 2018, got completely flamed on the way down. At the time, I was a civil engineer, and I was a very strange form of civil engineer called geotechnical. And that's to deal with everything in the ground. And what's interesting about geotechnical engineers, we know a lot about steel and concrete. They behave in a very particular, defined, characteristic way. Mother Nature gives you what Mother Nature gives you. So like the ground is a very, very different thing. You don't know what's down there. You've got to deal with a lot of risk. If you design for rock and you get clay, then you're stuffed. So you have to deal with a lot of risk, a lot of uncertainty, and honestly, a lot of, it's about right. So there's a lot of that in there, gut feel and trusting your instinct.
Sounds like trading, mate. Sounds just like trading.
And people ask me, like, what's the connection between that and markets? I'm like, everything. It's like, it's price, it's probabilities. It's like just trying to get your head around incomplete information and accepting what you don't know. So that was very kind of natural for me. Now, in the end of 2018, early 2019, the world of on-chain data started to explode. And in this time, I'd been studying markets. I had a portfolio full of shitcoins that all went to zero. At the end of the 2018 bear, I finally read the white paper, and something about Bitcoin specifically clicked. I was like, okay, this is really interesting. But I was very fortunate in that I'll call him my market mentor, Doc Severson. He's a pro options trader, again, self-taught. And he taught me all about the psychology of markets. People doing really, really dumb stuff when it's exciting and like buying everything at the top and then getting really scared at the bottom and capitulating at the same time. And as the world of on-chain data started to develop, I was like, wow, this is kind of interesting. We can actually see people who bought their coins, like me, at the 2017 top. They hodl all the way to the bottom, and then they sell everything on the same day, thinking, oh my God, it's over, I'm done. And they sell everything. And they all do it at the same time. And I was like, so you're telling me I can actually visualize dumb money and smart money using on-chain data, and then you've got the world of options, you've got the world of futures, and you're like, they're all speaking a similar language. And that's what I find so interesting about this. And here's a good example. What are you going to see at a market top? Old coins that haven't moved in a long time are going to be spending. They're going to be locking in a huge amount of profit. We're going to see a massive amount of call buying, and we're going to see futures funding rates through the roof. That is the sign of a euphoric peak. So you're starting to see all these different market segments telling you the same story. Go the other way around. What do we see at the bottom? People who bought the top and hodled through the whole bear on-chain, they all sell at the bottom. They lock in a massive loss. Funding rates go negative, and you'll see the puts go crazy because everyone's like, oh shit, I got to go and buy fire insurance. It's like, you probably should have bought fire insurance a bit earlier in the piece. So it's really interesting seeing these different market segments. They speak the same language. The data is different, but it's a holistic view of what's really going on.
Right. So, and now you're basically independent, right? You're writing a newsletter called CheckonChain, where you are not just looking at on-chain metrics, but you've incorporated now the options lens to try and get that extra bit of edge. Is that right?
Exactly. So from my perspective, I consider myself a Bitcoin analyst. Yes, on-chain is my specialization, but we have so much data. We've got ETFs, we've got spot, we've got futures, options, on-chain. And that really we're just getting a snapshot of like, what is the sentiment? Where is everybody? How are people thinking about things? So we've got a newsletter and a charting website. And like, for our charts, we've got heaps of options metrics. And that's what sparked this conversation. I've been studying IBIT recently, and IBIT has just exploded in size. And, suddenly you're like, wow, okay, the TradFi guys. And again, something Doc told me many years ago, options on Bitcoin are going to be the killer product for Wall Street. And then in like 6 months, IBIT has overtaken Deribit in terms of open interest size. The volumes are through the roof, and suddenly like, wow, you can see how quickly these things just come into the fore, and there's no question they're going to change market structure moving forward.
Yeah, it is pretty incredible, like the explosion in volume there, right? But I like you said, it's very much a sign how institutions have embraced this product, right? And
absolutely.
Something I've been keeping an eye on all year is like how longer dated skew in Bitcoin has been gradually stair-stepping its way into put premium, right? And people who watch this show will know what I'm talking about because they follow that conversation. But what do you make of that? Because that, for me, that's a clear sign, right? That long-term holders of IBIT are just structurally layering like risk reversals around it to be safe. And then they're just holding that, right? And that bill doesn't go anywhere, right?
So let me reverse that around. So I think a lot of people who are my audience, including myself, there's a lot of jargon in there that like, I kind of know what you just said, but I'm not that close to it. So I'd actually love to know from your perspective, talk me through, let's just say the last 2 months. How have you seen the options market change and shift, and how does it represent sentiment over the last 2-month periods? We've gone from all-time highs down here to 80K. What has that looked like from the options perspective?
Yeah, so I would say it's not just the last 2 months. I think it's probably the last 6 months, right? Where we were starting to see a shift in really, when I say long dated skew, what I mean is like 6 months and beyond, basically, right? So
duration.
Yeah, so front end skew, 1 week or 1 month skew is very spot sensitive, right? Which means that whenever we rally, people pile into the short dated calls and they sell all their puts out and they're chasing price. And then when it reverses, they do the opposite, right? So the front end skew is very fickle. It's just chasing
and
price.
Very speculative, and it's almost like a futures contract in a way, in the way that it trades. People are going to go hard in one direction, speculative.
Because they get leveraged. They get leverage to that sudden trend that is emerging, and they want to jump on it. They don't want to lock themselves into a really expensive option with a load of premium on it. So they're like, what gives me leverage? Short end options. And I'm going to trade the out of the money stuff you have to do that to get the leverage because that's the lower premium stuff. And I'll buy a load of out of the money calls or out of the money puts to chase price if this turns into a real move, basically, right? So either that or, when it was not really institutions who were doing it in billions and owning loads and loads of Bitcoin, you used to see people like me, retail people who are like long hodler types, but think there's a short-term correction coming and would use some short-term puts to protect that, basically, right? So that used to happen as well. So over the course of, let's say, the last 6 months, that long end part of the curve that used to always be in call premium because the structural view was crypto's got a lot higher to go, basically, right? That you started to see that story crack a little bit, and you started to see long-term skew move into a put premium. And I was looking at that and saying, is that like a regime shift? Is that like we're not in a structural bull market anymore? Is that long dated skew telling us something that actually there's something under the hood here that is changing? But actually, someone that I interviewed made a very good point that if we were starting to see the end of the crypto bull, Ethereum long dated skew should also be showing the same signs. Okay.
It's turning around the risk curve, right?
Yeah. So we should have seen altcoin skew moving into puts as well in the long end of the curve, which we weren't seeing. So it was a Bitcoin specific sort of thing we were seeing. And that basically made more sense that institutions have piled into this thing. The inflows that we've had into the ETF are in the tens of billions, right? And what do instos do when they allocate a load of money into an asset? They layer hedges on over the top, right? And so there's a structural need now to hedge a Bitcoin long. And, if you're an insto, you're not going to do that in the 1 month expiry, right? You're going to do 6 to 12 month risk reversals. So you've got your position. It's not going anywhere, but you've got a hedge on against it and you can sleep easy. And that was a structural bid that was coming into Bitcoin options, owning downside puts, selling upside calls to fund it. And we structurally saw that skew go from kind of maybe a couple of vols for call premium down to where it is now, which is like 4 vols for put premium in the back end of the curve. So that's really
out of interest. I'm just looking at my put call ratio. Is there a way I can share screen just so I can show you what I'm looking at here?
Yeah, let me give you permission.
Yeah, because I think what from my perspective, I've actually been watching Deribit, which I consider to be, let's call it like a crypto native, right? It's the hedge funds who've been around. They can trade in Bitcoin. They're native to the space. IBIT is a very different beast, right? It's going to be TradFi. It's based on the ETFs, trades 9 to 5. This is me just modeling out the put to call ratio for Deribit and for IBIT to compare how they perform. Now, when the IBIT options first went live, they were trading very, very similarly. But then from about July onwards, we saw Deribit, the put, as you were saying just then, the put side really started to creep higher and has been trading much higher for a long time. Whereas for IBIT, it still maintained a very heavy call premium for a long time. And I'm looking at it right now. Those two have collapsed and crashed right next to each other. So to snapshot what this is, the green and the red is Deribit. Put to call ratio, all open interest, all expirations, just looking at the overall put call. Purple is IBIT. So isn't it amazing how they diverged through that 6-month period you were talking about, July onwards, and they're literally collapsing back together as we speak?
So before you're saying when we had IBIT, we had much higher put volume. Is that right?
Calls. So lower values means that the put to call ratio means it's the lower value. So there's more call open.
Oh, there was
open interest base.
Okay, interesting. So that was saying that the initial flows in IBIT were more speculative, trying to get long calls basically, right?
Calls. But the other thing I think is quite interesting is I think there's a lot of long calls for sure, but every market has two sides. And I think the idea of the covered call is a huge component of what's going on. This is where I think gets really interesting. And I love your thoughts here. How options, if you think about futures and options, they're obviously levered instruments. A lot of people will think paper Bitcoin, instruments trade on top. But the truth is there is a link between spot and derivatives. Because when people have a levered position on, sometimes it's easier to lean on the spot market to achieve their intended results. So there is going to be this link between the two. Now, when you've got all of these covered calls being sold, it's going to be taking some of the steam out of the market because effectively they're selling the volatility and pulling it out of the market. But also periods of time where too many people have sold too many calls. And then if the market really wants to run, and right now in terms of IBIT, last I checked, about 8% of the calls in the entire IBIT book are in the money. 8%. So there's a massive call bias, except no one's in the money, which is a fascinating dynamic.
Yeah, definitely the call overwriting flows are a general vol suppressive instrument, right? So, you see it on S&P, for example, in TradFi a lot. Street gets stuffed in a load of upside calls, and the market generally grinds its way up into that area, and then realized vol completely collapses. And
so can you just talk through why that happens? Why does the vol of the spot market decrease so much when you have all of that volatility selling? What's the actual mechanic for that?
So think about the two different sides of that, right? So the people who are selling the calls, they don't need to do anything, right? They're long the underlying asset. They sell the calls, they collect the premium, and then that's it. They wait till expiry. Or at some point they decide to roll those calls to a new expiry or whatever it is. But generally, throughout the life of that option, they're not touching it. They're not doing anything with it really, right? So then what is the other side of that trade doing? That's the dealer who takes on those calls. They're not just sitting there long naked calls and hoping the market goes up, right? They're delta hedging those calls, which means they have to sell spot or sell futures. So now they've got a option that they're long and they're short futures or spot against it. So they're delta neutral, right? So, but they have a volatility position, right? So every day that option's losing some value, right? It's called time decay. And the dealer's not just going to sit there and do nothing and lose money every day, right? That's not their job, is to try and extract value out of this option, right? So the way they extract value out of this option is they trade their gamma. There's this thing called gamma that is attached to these options, which means that when the market goes up a little bit, you actually have some extra delta that comes from the option that you can now sell some more futures. Or if the market goes down, the delta of the option shrinks a bit and now you've actually got to buy some futures, okay, to stay delta neutral. So when you have a long gamma position and you're a dealer and you're delta hedging it to try and stay neutral and you're trading just the volatility of the asset, when spot goes up, you become a seller. And when spot goes down, you become a buyer. So what that naturally means that when the market's moving up, there's a pressure to move it back down. When the market's moving down, there's a pressure to move it back up from these dealers that are just hedging their book. So that becomes a force of gravity that makes it really hard for the market to move very much, because there's this natural mean reversion flow that is coming back whichever way it goes to kind of keep it where it is. So the more gamma there is,
something fairly explosive to come in, you need whether it's explosive demand or explosive sell side to create the gamma squeeze. So let's say the market starts heading higher, it goes and hits a bunch of these call options. Suddenly their delta or their probability goes through the roof. Suddenly you've actually got this dynamic where the people who you said earlier who didn't actually want to do anything, they've sold a covered call. They go, oh, hang on a second. Maybe I need to roll my contract. Maybe I should actually just get out of this option. Suddenly you get these extra flows, which changes the dynamics because there's a big impulse of demand or sell side.
Sure, exactly. If the end user, if their behavior changes and they get forced to cover, then that can create a massive squeeze, correct? Right?
Got it.
But without that, the dealers will just keep doing their thing and that will keep volatility contained. So a really good example of that would be what happened with Ethereum a couple of years back, where there was monster size call selling in Ethereum. It was such a dominant flow. There was no other flow to counteract it. And Ethereum vol was trading like 10 vols plus below Bitcoin, right? Because this call selling was just unbelievable. Okay. And it meant that the Ethereum just couldn't move and it was just stuck and it was range bound. It was doing nothing. And Bitcoin was actually more volatile for a while. Right. But then we had a repricing of Ethereum. Like it caught a bit of a narrative. It caught a story. It was maybe the ETFs on Ethereum came about or got approval. And suddenly there was like a re-rating in Ethereum. And that's when the options dynamics don't really matter anymore because the spot flow is so large. They just blast you through all these strikes. And the guys who sold all these calls are like, oh, okay, we're going to have to cut this position because it's lost too much money. And they buy them back. And then they don't sell anymore. And so that supply that kept coming just dries up. And then Ethereum vol reprices back to where it belongs, which is flat or 10 vols over. Or now it's 20 vols over because it just gives you a clear sign that there's a load of Bitcoin supply, but there's hardly any Ethereum supply relative because Bitcoin is kind of saturated now in terms of institutions have adopted it and they're selling calls against it, and that's just structural. Whereas Ethereum is kind of like maybe there's still more to come in terms of that flow for there to be a massive call overwriting on the back of it, right? And also people have probably got a bit of memory of how it went from like 28 to 4,800 in a matter of a month or something. So like actually selling calls on Ethereum might be a bit dangerous, right?
So it's one of those interesting things where, because I think about options as a market for volatility, because I think that's really what they are. You've got a market for volatility, and more volatility begets more volatility. People start selling all, and this is why you can look at implied vol as a bit of an indicator. And here's another actually really interesting concept. there's a metric that we have in the on-chain world called sell-side risk ratio. Now, it basically looks at you look at all the coins that are moving on a particular day. The coin that last moved at $10,000, right, was bought in 2019. When it moves at 100K, it's locking in a $90,000 profit. So what we do is we sum up all of the profit and all of the loss that's being taken by coins. Think about like the delta that's being in terms of a change of coins cost basis. Put all that together and then compare it to how big the asset is. That metric, purely on-chain, purely based on are people saying, I think the market's overvalued, take profit, or I think the market's scary, I'm going to take a loss. When you put all of that together and compare it to how big the asset is, it looks identical to implied volatility. So when implied volatility is very low and no one's taking profit, no one's taking loss, it's telling you that too much volatility has been sucked out of the market and it's about to move. That repricing you were just talking about, investors are saying it's time to go somewhere else. We cannot stay in this range anymore. And then once you get a volatile spike, people, as you said, will not sell the calls because until the market hits some kind of a plateau, they're like, I don't want to get run over. I'm going to wait until this thing starts to look like it's topping out and it's a good time to start getting back in. So this like trend in volatility starts to burst back into the mix. So it's a very, very interesting dynamic.
Yeah, I mean, exactly. I think in Ethereum and alts, there is that somewhat fear that, okay, we don't know when it's going to suddenly reprice and do crazy stuff like 50% in a month, right?
Sure.
Bitcoin, I don't think really it has that fear anymore. I think the call selling comes back quite quickly. So Bitcoin will have its move. It will realize quite a bit for a week. And then first sign of calm, the call sellers will come back, right? So we're already in the last week, we bounced back above 90K. There was call selling coming back in decent size. There was some put buying. So those risk reversals were pretty active. Again, people coming to sell the upside and buy the puts. But let's zoom out a little bit. So like, tell us a little bit about what you're seeing, right? Because obviously you're looking at all these different lenses now for the market to get your insight, right? So, you look at things like liveliness. I read a bit of that on your page and stuff. So what is your kind of 30,000 foot view now looking down on this correction that we've had? We hit 80K, we've bounced quite nicely off it, but do you think that is the ultimate bottom of this correction that we've seen, or how are you looking at things right now?
Yeah, so my general view, if I kind of describe what 2025 has been, I think in my view, the last 2 years there's been three major things that have happened to Bitcoin that have driven this whole market cycle. First one, the ETFs going live. Huge, just like checkbox for institutions, giving them the access, all of the above. ETFs going live, the IBIT options going live, because now they've got the tool where they, if you want to sell covered calls and earn an income, it actually makes sense to own the underlying in the first place. So it creates that demand. And in the early days of the ETFs, we saw a lot of the CME basis trade where they would long the ETF, short the futures. That has died off. It's still there, but it's much, much smaller. And we've seen IBIT options just explode. Open interest moves alongside the ETF flows. So these two things are now inextricably linked. So those two, ETFs going live, options going live on the ETFs. And the third one, which a lot of people are only just starting to get their head around, is the tremendous amount of sell side in the spot market. We've seen, I know Jordy Visser described it as the IPO moment. There's a few ways you can think about it, but we've seen $110 billion of 5-year-old plus coins, all-time high across the last 2 years, come back to life. There's just been a shitload of old coins coming back to market, selling into the spot markets. And remarkably, honestly, if you take away the last month, the fact that we traded sideways under the amount of pressure we were under was quite extraordinary, honestly.
Yeah.
And for a long time, I was very, very impressed by saying, guys, there's just a lot. And to give you a bit of a framework here, if you price every coin in the Bitcoin network when it last moved, 70% of the dollars that have ever been invested in Bitcoin occurred above 90K, right? So all the wealth in Bitcoin is above 90K. So from my perspective,
that means you've kind of, the buyers have shifted to buyers who have bought it over 90K, basically.
Correct. So there's a few things to think about there. One, that is serious institutional demand. We're talking about $700 billion worth of capital, because when we price things based on when they last moved, there's about $1.1 trillion invested in Bitcoin versus its $2 trillion market cap. You've got about 70% of that above 90K. So the buyers are serious and they're here at high prices. However, we're also now below their cost base. So there's a lot of people who are going to be going, did I make a mistake? What have I done? So then I take that view. That's our current setup. We're trading below the cost bases of most people. Where is the next big cost basis cluster? The 2024 zone between 50 and 70. So my current base case thinking, there's two layers to this. I think that the 2024 zone, we prove that we're $1 trillion asset. That's 50K. And I think that going back down to 50K means you've kind of undone the ETFs. They went live at 45. Just from a qualitative standpoint, I think that's too far. Now, there's a lot of people looking at the 200-week moving average at about 56, possible, not my base case. So there's a lot of people underwater, and you would think, by the way, the ETF cost basis, if you look at the inflows, the average ETF cost basis is 82K. Globally, across the whole Bitcoin network, the active investor cost basis, 82K. So you've got the on-chain world has the same average cost basis as the average ETF investor, 82K. And we're there, right? That's pretty much where we've bottomed so far. So my current thinking is, if we're at the cost basis, 60% of the ETF flows have been at a higher price, 70% of the Bitcoin network is underwater, you would be expecting massive ETF outflows, like massive. We've seen the AUM decrease in Bitcoin terms by about 3.5%. Of the total 63 billion that has gone in cash, we've seen about 8% come back out. That to me doesn't feel like it's over. Get out of Bitcoin at all prices, it's dead. So I'm in this interesting world where I've been saying to my subscribers, I think we need to attack this with a bear market lens. And that means that rips will probably be sold into. We're probably not ripping up to all-time high anytime soon. Expect people to behave like it's a bear. But then on the second breath, I say, look, this bear probably isn't going to be like previous bears, because in order to reach previous bear market levels, you really have to undo a lot of productive stuff that's happened. You've got to go back to the pre-ETF price. And that to me just feels wrong. Can happen, but it feels wrong to me. So my base case for now is I think we bottom somewhere above 70. That's my current thinking. It's based on gut feel, but I think the bears are going to have a hard time getting us down through 60, down to 50. To me, that's going to be a really hard sell. I'm of the view that Bitcoin's undervalued. Personally, I think it's undervalued now, but I also know the market can do what it wants to do. My current thinking is we're in a bear, not going to be like previous bears, taking the old rules and applying it to this time, probably going to get lost in the sauce.
Do you see the MicroStrategy risk as being significant? People are obviously talking a lot about him needing to sell some Bitcoin and that having an outsized impact on the market because he's got so big. What are your thoughts on? I know you've got some thoughts on MicroStrategy again, because I saw you talking about the MNAV was at 0.85 or something like that.
Yeah. So no, I don't fear MicroStrategy at all. And truthfully, when you go back and look at previous bears, in order to reach that 56K level, which is where we've bottomed in previous bears, just look at the last one. To go from where we are right now, that active investor cost base, as I mentioned, that's like the middle. It is, statistically speaking, the middle of the Bitcoin market is at 82. To go from 82 to 56, which is that trip from the middle to the bottom, in order to achieve that, last time we needed 3 arrows, we needed Luna to implode, we needed FTX to be a fraud, we needed Genesis, we needed GBTC, choose your weapon of problems that was out there, right? So the only thing that I could genuinely think of in order to achieve a similar level of cataclysm is strategy blowing up, or something in the world of, I'm literally, as we speak, writing a piece on quantum. I don't think quantum is going to hit us anytime soon, but I do think that there could be a narrative, a headline, a breakthrough that just scares people. Now, I don't think that's going to be a long-term event. I think that'll be a flash type event. But on the strategy topic, no, actually, I think first and foremost, their cost base is 74K. I've been saying to my subscribers, just imagine the headline. Price goes down to 74K, sailors Bitcoin bet goes belly up, perfect kind of stuff you see at bear market floors. These doom and gloom headlines. They just raised 1.44 billion to service the dividends. They are so strapped up and ready to go for whatever comes. I have no concerns, honestly, about strategy. That is something that could go wrong. It would be quite destructive. I just really think the probability of it is quite slim.
Okay, good to know. Because a lot of
and sorry, just let me add to that. The rest of the Treasury companies, the rest of the companies aren't big enough. they didn't get big enough for anyone to lend them any money. So there's not even that much leverage out in the system. So, they got 1,000 coins, 2,000 coins. Okay.
But are you a buyer of strategy stock down here then?
That's an interesting question. So actually what I'm currently doing, I'm a buyer of strategy.
Not financial advice, by the way.
No. And I always talk about this from my own personal perspective.
Yeah.
I sold my strategy at 300 for a loss prior to this sell-off because it was my risk position, right? 2% of my portfolio. I said, look, something's wrong. We're like 110K, 105K. So something's wrong. Here's my bear case where I think is just not playing out. And more importantly, I bought the risk position expecting it to do better as Bitcoin punched new all-time highs, and it did. So my thesis of it's going to work better than Bitcoin didn't work, so I cut the position.
Makes sense.
Now that we're at 180, now I'm starting to get interested again. And I'm not quite sure we've bottomed yet. I mentioned we might go down to 70. And I also think that given strategy has an MNAV of, it depends how you want to measure it, but it's close to 1. Strategy is really going to trade. I don't think it's going to MNAV of 0.5. So I think it's going to trade a lot more just like a direct Bitcoin proxy, right? It's probably not going to have too much leverage. It's going to be Bitcoin for a while. So now I actually become quite interested because I don't mind being long Bitcoin here. And if MSTR is going to trade like Bitcoin, I also don't mind being long MSTR because it's kind of trading the same asset. So what my strategy is right now, I'm actually looking to sell cash secured puts while I wait and just see how this bottom starts to get hammered out. If I get assigned, don't care. I'm very happy. I want to buy the thing anyway. So that's actually how I'm playing this current environment. Just waiting, taking that premium, short dated, week, 2 week type contracts.
Okay.
Just getting paid, waiting, and then when the time
the strategy vol, I guess the strategy vol is a little bit higher than Bitcoin vol.
78, 80%, something like that.
Yeah, whereas Bitcoin vol is more like 50, right? 40, 50.
45, something like that.
Yeah, so you're getting a bit of extra juice for something that you essentially think kind of moves like Bitcoin, right?
And I guess if it goes down, I get assigned, I'm happy.
But you got the sentiment. I guess you got the excess volatility of like they might trade at an MNAV discount because sentiment is so bad. But ultimately, you think that shakes out and it kind of mean reverts back to an MNAV of 1-ish anyway. So then when it does look really weak and everyone's like crapping themselves on strategy, that's the time to enter your cash covered puts, basically, right?
Exactly. And that's the strategy, right? So, from my view, I'm looking to get back in, but I'm also not rushing. And that's what I've really been trying to paint the picture of. Like for me, I'm not rushing into this market. I'm very happy to just accumulate BTC as my just spot position. Don't care. That's like just regular accumulation. But I also think we might get lower prices, but I'm also not waiting around for 50K. There's a lot of people out there waiting for 50, 60K. I'm not waiting for those prices.
Yeah. I mean, I think 74K is going to be a big battleground, right? Like that was, that to me on the chart, that looks like a very, very key level, right? That it needs to hold. If that breaks, then we may have a quick trip down towards the 50s, but the news flow would have to be pretty ugly, I think, to get us down there. All right.
Well, that's Sailor's cost basis, 74, which is, again, picture the headline. What do you see at bear market bottoms? Yeah. Bitcoin back goes belly up once again. It's like, okay, that's my sign.
We need like a Economist article or front page going from hero to zero with a picture with a picture of Michael Saylor, and then the bottom's in, basically, right? So
you choose any one of his, him floating away in a boat or something, or riding a cowboy,
All right, we've talked a lot about Bitcoin. Before we wrap up, what are you seeing with Ethereum on chain? Are you looking at that closely? The vol's been established now in 20 vols above Bitcoin for a long time now. Realized is clearly up there as well, has been. Do you see any big kind of divergences between what you're seeing on chain and Ethereum and what you're seeing?
Truthfully, since starting CheckonChain, we've just focused purely on Bitcoin. So it's more so I just don't have the time to look at. I mean, a Bitcoin alone keeps me more than full time. But I'd be curious, like, what's your view, not only just on like the now, but can you actually tell me what you've seen for this cycle? Because this cycle, I think, left a lot of altcoin investors scratching their heads, going like, wait a second, where's my market? What have you seen from the option side of the equation? Because I mean, we've seen, I'm pretty sure Deribit has Solana options as well. How have you seen kind of the movement of funds within your world through this cycle? Because it hasn't been a normal cycle for most people, especially in the altcoin world.
Yeah, I mean, I would say it was a case of, a lot of people were using Ethereum calls as like a funding leg to own altcoin volatility. So you are seeing, whatever like treasuries or whatever it was who were long all these altcoins, they might sell like OTC calls to some of these dealers that were out there. And because there wasn't really the liquidity to recycle that, they would just sell Ethereum vol against it, basically, right? So the supply of Ethereum options would come from the fact that, there's a supply of altcoin calls that comes from call overwriters who just own a shitload of altcoins, and it finds its way to Ethereum upside, okay? But then when Ethereum did the crazy shit with the Ethereum Treasury, Tom Lee buying his ridiculous however many billion of ETH, I think that did dry up a little bit. I think people got a bit burnt in being short gamma on Ethereum on the upside. And so it's like, I don't think they're quite as keen to go and smash a load of Ethereum vol out again, right? So that might come back, but I just think it's taking longer to come back because people look at the relative value and say, actually, I feel more confident being short gamma on Bitcoin and earning theta through that than I do being short Ethereum, even though it's 20 vols over, because this thing could do anything, right? This thing could do 1,000 points in like no time, and I have no way to protect that. So I feel like that's kind of what's happened in Ethereum. And then when you look at the long end skew, it's still very, very marginally in call premium for Ethereum. So it is like people do think Ethereum has got some serious upside still in it, but they pushed that scenario further down in time. So whereas they might have thought that was going to happen like March next year, right? They've now pushed that to towards the end of next year. There still could be a Ethereum bull case that comes back where this thing does start to attack 4,000 again or whatever, but they just keep kicking the can down the road. But we haven't gone into full bear market territory in Ethereum in terms of the options vol surface saying, okay, bull market's over or anything like that. And then, things like Solana do trade at a premium even beyond. So like you might have ETH trading 20 vols over Bitcoin. Solana will trade another 10 or 20 above that, basically, depending on like how it's moving in the moment kind of thing. So
sure.
I still think Solana upside is not a bad thing to have in the book, but you got to be patient with that one. Like I wouldn't spend too much premium on a clip just because, if you get your timing wrong by a month or two, you're just going to lose all your premium, basically. So you got to be selective about it. But I think having some Solana upside parked in the book, every quarter, having a little budget towards upside for Solana to get some leverage to that move when it does finally decide to wake up, that I think that's okay. I don't think that vol's ridiculous. Probably call spreads are a better play than outright calls just because they decay better, and do you really want to buy a load of outright vol at 80, 90 vol, which is kind of where it's priced? Probably not, just to be safe. So I think call spreads look okay. They give you decent leverage, and that would be how I would do it.
So if I can just lever a couple of other questions, and as we move into this world where, particularly with the expansion of TradFi options, how do you think about, let's call it, you try and use different words here, like magnets for price, things like two things. I want to understand a little bit more about how you can read with option, what kind of metrics and tools and ideas look for regime shifts, moving from a bear to a bull, from a bull to a bear. How do you see the flow start to change, and what tools do you use to look at that? And then also, let's say we're in the current environment. Obviously, you get like call walls and put walls, and they tend to be your support and resistance levels. How do you then look at obviously they're one snapshot, but is there any other metrics or tools or things you do to try and track where does the market want to go? Where's that gravity pulling it towards? So kind of reversals and gravity. How would you describe those two things in the option space?
Yes. So really, it is a big debate. Like, are the options having enough impact on spot for it to be like TradFi, where you look at the big strikes on S&P and it's like very clear that there is gravity towards those strikes in certain moments of time? I would say in crypto, it comes and goes, right? I would say when there's a big narrative within crypto and the spot is trading in size, right? Then the options market just isn't going to feature. It's not going to matter that much, basically, right? We're going to blast through whatever option zone is relevant. We're just going to blast through it. It doesn't matter.
Which
right?
arguably is what we've just seen to the downside. We had all that selling going on. Didn't matter what was going on. That's why 8% of all calls are in the money. Doesn't really matter.
Exactly. But then you'll get periods of time where actually there's not much going on in the spot market and options are actually very relevant, right? So, you had a big strike 3,100 was a big strike for last Friday's expiry. That did seem to have some gravity to it on Ethereum, basically, right? Because there was nothing else that was really in the moment moving it.
Sure.
So I think it's quite tough to make the call. You can monitor it where the big open interests are, but the problem is you kind of don't know if some big flow is going to come in the spot market and make it irrelevant. That's the problem. And I don't think it
makes sense.
I don't think it's big enough right now to say that it doesn't matter. Like there will always be a gravity, basically. So I think we are headed that way, but I don't think we're there yet. Right. So in terms of the gravity, yes, it's something to keep an eye on, but it will always be, if nothing else is going on, then these strikes matter. But it's a big if. We don't know. Right.
Yep.
In terms of the reversals and picking those things up, this is something that I think is relevant for all asset classes. And that is, if you start to see spot going in a direction and skew has been kind of moving that way with it. So let's say we're going down and skew has been going up for puts basically on the way down because people are trying to protect against that move, right?
And sorry, just so I just to make sure I get this right, when you say skew, you're basically looking at there's more volatility premium. You take 25 delta. There's more vol premium in your puts than your calls.
Yeah. So you look at the implied vol for a 25 delta put, compare it to the implied vol for a 25 delta call, and if the put is trading on a higher vol, that's a put skew, basically, right?
Got it.
So generally, when the market's selling off, we would expect that put skew to increase because more and more people are trying to protect this sell-off, buying puts, and they're using calls to finance those puts, and they're selling those calls, basically, right? That's making that skew price more steeply to puts. Now, if you start to see us hitting a bottom, like a previous bottom, like 80K, for example, and when we're hitting 80K, the skew is no longer steepening for puts and it actually starts to move the other way. Even though the spot price is kind of near the lows or even grinding a bit lower, that is a potential signal of a reversal, right? Because that's showing you that whoever's bought a load of puts is now starting to think it makes sense to monetize those and let those puts go and maybe even start buying calls to try and play the bounce, right? So that can often be a bit of a lead indicator for a reversal. And that's what we call that skew divergence, where skew is doing the opposite of what it should do when the market is trading down. And it's not a foolproof signal. Just like anything.
No, that makes sense.
But a skew divergence, if you're seeing it, it should alert you that, okay, the options market is thinking that this could be an interim low here. Maybe I need to be covering some shorts or keeping a tight stop on my shorts because, we've got smart money coming in and doing the other thing, basically.
Understood. And out of interest, because I'm aware of the 25 delta skew is a fairly common one. Is there a reason why you would use 25 or any other delta to compare these things?
But 25
just kind of benefits for those?
25 is just a standard metric because it's like, it's far enough from the money for it to really be an out of the money option, basically, right? If it's a 40 delta, it can behave very similar to an at the money, right? It doesn't feel out of the money enough, basically. But when you go to 10 delta skew, then it's very out of the money, and it's like what we call a wingy option, basically, right? And it's kind of
looking for the real spec positions.
Yeah, and it's like that can be distorted by people trading spreads as well, right? So like if I'm a call spread buyer, I might buy a 30 delta call and sell a 10 delta call against it. So I'll be bullish, but I'll be a seller of the 10 delta call. So the move that I'm seeing in the 10 delta call might look like I'm bearish, but actually I'm doing a bullish trade because I'm doing a call spread, right? So like the move in the wings is a little bit, a bit funky, and you so that's why you just focus in on what the 25 delta skew is doing, right?
Yep, no, that makes perfect sense. Just out of the money enough that it is going to give you a nice signal, and makes perfect sense.
And it's got a bit of leverage on it. It's got a bit of meat on it. It's not so far out of the money that it's just crazy speculative and low probability of ever happening kind of thing. So that's when you break down a vol surface, like you break it into those different parts, like the at the money vol, the 25 delta skew, then the wings. They're all parts of the building blocks of what a vol surface is made of, right? And they kind of tell you different things. Yeah,
very cool. Man, that's awesome. I've learned a lot in this conversation. It's been the options world is endlessly fascinating, and you can see why Wall Street loves it because it gives you so many options. And I've been saying for a long time, maybe you can say I'm completely wrong or right here, but I've been saying for a long time, when the options come live, particularly for these ETFs, if you're a big institution, you can't go and buy $1 billion worth of spot if you can't hedge a serious amount of risk. And the bigger these options markets gets, it actually makes the spot more viable they can put the position on in the first place. And I think that's something a lot of people miss. They look at it and go, oh, options are just going to control the markets. Like, they're a big part of it, but the big money can't buy without them. Huge part of the insurance space.
Mate, couldn't agree more. I think you're totally right. It just gives you the flexibility, right, to manage your money more intelligently and control your risk. And if you can control your risk, that's when a big asset manager with billions under management can come and play in the space. And we've definitely seen it happen. And we've seen all the telltale signs of it happening and that market becoming more and more mature. And that's why volatility has been decreasing because of it as well. And hopefully it just kind of expands itself to the whole asset class and we get much more liquidity in the likes of Solana, Ethereum as more and more instos adopt it. But it's been a great conversation. I'm really glad we made it happen, mate. Thanks for coming on the show.
Absolutely. You on it, mate.
Right.
Thanks for having me on.
And have yourself a good Christmas and a happy New Year.
You too.
And I'll speak to you. Hopefully we'll chat a bit more next year.
Sounds good, mate. Cheers.
Take care, buddy. Okay, so yeah, checkmate. Awesome views there and insights from him, right?
Joe, it's quite interesting because I assumed checkmate was because I say Bitcoin's a checkmate trade, right? like, you know, they're covering the tail end risks.
Yeah.
But obviously it's not. Yeah, really interesting. Like, I think like quite a sensible kind of balanced view on the market, right? And I guess kind of not out of line with some of my views in terms of if we don't get something from the Fed, we still feel under pressure.
There's still a bit of an overhang, isn't there, from from what you're seeing on chain as well.
Yeah, and you see it, right? We equities bounce, Bitcoin ticks up a bit, but equities then drop and Bitcoin sells off a lot more. Yeah, definitely feels like that's the weak side of the market right now.
So is that 74K area? Does that need to be tested before we can call time on this correction, right? That's the big question.
I think that's always the fear, right? Like you know those big levels are out there. Although again, I remember back in April when we were after the whole tariff stuff, and I think we were down around 70K, was it? I think. And then people were talking about 65, and and it kind of felt like destined that we were going to test them levels, and then we just didn't. Yeah. It feels like a lot of leverage is obviously being washed out. I guess the really interesting thing is just knowing that all those flows now are kind of underwater. What did he say? It was around 90K or whatever.
And then MicroStrategy's average entry level, right? Their cost basis is around that 75K area, right? You're saying.
Yeah. But then like I guess he's kind of interesting, again, a view that aligns with mine, that Saylor's funded for the next 2 years and what he needs to pay out.
So it doesn't. Yeah. The chances of a real blow up happening there, you would think are limited, but
and also, by the way, Saylor bought a chunk right the other day of Bitcoin, and there was all that FUD over the last week or so that he might be selling or need to sell, and he's just come in and bought like a massive lump. I forget how much it was, like a huge amount again. So I think that's really interesting. I think for me, I think his view kind of probably plays out in the absence of the Fed doing something, or the absence of something snapping in Japan. Like if we just kind of continue chopping around this, it's probably just going to be like continued kind of sell flows from whales. Maybe some of the institutional money just gets bored and wants to come out and then try and find opportunities elsewhere. That's where you're at risk, I guess, for that downside.
I feel like the institutional money, and we touched on this in that chat, was like the institutional money is layering hedges over the top, right? Yeah. So they don't need to like dump it. Yeah. Right? They're kind of protected. They're just going to roll their hedges, right? Yeah. So I don't feel like there's a big risk that a load of institutions who've allocated are going to suddenly then dump it just because it's going lower. Because they're the ones who are creating that put skew throughout the longer part of the curve to protect their holdings, right?
Yeah. And I do feel that I think that loads, and there's someone myself and FR&T Financial where we've spoke to big institutions and kind of sold the story. I think they all get, like, these proper markets guys, right? They get the volatility in it, and
to be expected,
and their position size in most cases is small and reflects that, right? So
that's true, yeah.
So there's not a need to like puke out and
whereas retail tend to be the types who get overextended, over leveraged in a volatile asset because they think it only goes up, and then you see that volatility on the downside and they get stopped out, right?
And to your point, and as we're seeing, as it's already materially impacting the structure of the options market. Like they're hedging themselves around that, so they're managing the volatility around it in a way that retail often hasn't, or so there's probably going to be less panic from institutions. I just feel the market. Yeah, it just needs a spark, like to
So I think you don't need
shift to the upside. Yeah,
you don't need to go into the FOMC with a big bias either way, right? It's like let it happen. If we get the signal we need that they are really turning the taps on, then yes, you've probably got some upside that you can chase in crypto into year end.
Yeah.
But if they don't deliver anything, and we do want to test those lower levels, you probably want to wait until you get into those sort of mid 70K area before you really strap some risk on again.
And because you know yourself, like, I mean, the fear is, again, not fear, but like after Wednesday, does the market then just go, if nothing kind of happens, all right, that's it, I'm done for the year.
Shut the book up.
And then shut the book up. But shutting the book up for a lot of people might be, do you know what, let's just sell out my Bitcoin and then enjoy Christmas and not have to think about too much.
De-risk it.
Yeah, and that could put things under pressure. And then to say you are going to have like the usual funding squeeze and all these things. Dollar tends to like rally into year end.
Yeah, it could easily happen.
Yeah, and then if that weak side of the market's there, so it feels like the Fed need to pull a rabbit out of the hat to maybe really sort of generate some momentum into year end to rally to the upside. And I do think there's a very good chance they do that.
Okay, we'll leave it there. Remember, like and subscribe. Dave, this was your last episode of the year.
For the year, yeah.
So we're not here next week, but I'll be back in a couple of weeks for a final Christmas episode. I'll see you then.